The resilience of the U.S. consumer has been one of the stories of the year and has kept a so-called imminent recession just out of arm's reach. But the backdrop has become more nuanced in recent weeks. Surveys showing tightening credit and weakening consumer demand contrast with upbeat consumer confidence readings. So optimism is trending upward, but spending isn't. Let's get to Apollo Global Management Chief Economist Torsten Slok, who has some great insight on this. So Torsten, first, thank you so much for joining us this morning. I want to ask you, though, what do you make of that? Is there a disconnect between how the consumer is feeling versus what's actually happening?
Oh, that's a very good question, Diane. I think that the key way that we should be thinking about this is that the Federal Reserve started raising interest rates last year. And when they started raising interest rates, the economy gradually started slowing down. It was the interest rate sensitive components of the economy that slowed down first. It was housing that slowed down. It was purchases of autos, purchases of washers, dryers, furniture, anything that requires financing saw an initial reaction in a gradual deceleration. Now that's also spreading to other parts, in particular of consumer services. Going to a restaurant doesn't normally require financing the same way that if I go out and buy a new piece of furniture. So what's noteworthy is that we've begun to see some slowdown in restaurant indicators. So the broad answer to your question is that this process for the Fed of slowing the economy down is just taking a bit longer time than what we all had expected just even 6 months ago. But it is in motion, as you're mentioning. Delinquency rates have gone up on credit cards, on auto loans. We're seeing slowing growth in retail sales, in same-store sales. So the conclusion is we're still in this process of slowing growth down for the consumer. It's just taking a little bit longer time, most likely because they still have savings left. But at the end of this, in the next few quarters, consumption should continue to be lower.
Well, one of the other things, Torsten, hey, it's Julie here. One of the other things that's cushioning them is they have jobs. And guess what? Not only jobs, but they're actually making more money. And finally, we are seeing wage growth outpace inflation. So given that, it's taking longer. How much longer is it going to take?
No, you're right. And as you reported on earlier this morning, also jobless claims today actually came in a bit lower than last week. Continuing claims, meaning how many people filed for claims, meaning for unemployment benefits, actually went up a little bit. But the conclusion still is exactly what you're saying, that it is a little bit of a puzzle and probably some frustration at the Fed. Why is it that the labor market is still holding up so well? Let's not forget that the whole reason why the Fed is raising interest rates is that they want to slow the economy down. They want people to buy fewer cars. They want people to spend less money on their credit cards. They want companies to hire fewer people, but it's just not quite happening yet. So that's why this waiting game that we've been in, where for a long time financial markets have been saying, oh, the wolf is coming, a recession is just around the corner. We probably have to wait a little while longer. And I do still think that the main reason for that is that the amount of savings that people have left after the pandemic are still substantial. And therefore, we need to run through those savings. And that's what we will see over the next 6 months, where those savings begin to run out for different types of households. And ultimately, therefore, that will begin to create an increase in the unemployment rate.
So what is it that does start to impact? Because I'm glad you brought that up. I was thinking of the excess saving. Consumer bank accounts have been propped up. We continue to talk about that leftover savings from the stimulus. And again, the strength in the job market, excess savings, I guess, based on some 2022 data, was at just under $1 trillion. How long does that excess savings runway last? Is it dented by, say, the coming back of these student loan payments?
Yeah, no, this is a really good question, Diana, because the issue is that even the Fed, there are several working papers that have tried to quantify the answer to your question. So San Francisco Fed came to the conclusion that there's still plenty of savings left, at least until the end of this year, whereas the DC Board of Governors Fed, meaning the Federal Reserve in Washington, basically came to the conclusion that, well, households have already run out of savings. So the jury is still out on that question. That's why the homework for us in markets is to try to look at some of the weekly and even daily indicators, and of course also the monthly indicators for what are consumers actually doing. And what we saw in retail sales that came out last week, we basically saw, again, step down more and more in consumption. There's a lot of different areas where consumption is still doing okay. There's some areas where it's slowing a bit more, but the big picture really is that consumer spending, if you look at it year over year, continues to move lower and lower. And in particular with inflation coming down, remember, retail sales is measured in nominal terms, and inflation in nominal terms is, of course, coming lower and lower. And if that's the case, you should also expect consumer spending in nominal terms to come down. But the conclusion is, to your question, we have been waiting for this recession for a while, but it will come. We just have to wait a little while longer. And that's what's so most important for markets today, because equities obviously are not trading as if a recession is coming.